at the same time, here it is on the West Coast where I'm broadcasting from. It's 10 o'clock. Where you are on the East Coast, it should be 1 o'clock. We are um, going to look at the fact that we are only 4.5 weeks away from the beginning of the 2024 tax reporting year. Can you believe that? 4.5 weeks. So, and this, of course, comes after the momentous November 5th general election across the country, across all 50 states, which is still taking. Apparently, I don't think all of the states have actually reported on their election results, but in any case, it has already been called for Mr. Donald Trump, and so we will be this morning. Will share with you some updates that I was not around to advise you on over the past few weeks. And then we're going to take a look at a article that is entitled, of all things, well, we really cannot expect a return to the Trump economy. Wow, that's cannot. Negative, as opposed to expecting a huge return to the Trump economy, no matter what claims have been made from the political pulpit. Perhaps even uh, uh, I guess uh, a fairly um, a good return might be something that might be in the category of impossible, despite the support that Mr. Trump gained, had during the election. That should be interesting to share with you. We'll be quoting opinion pages from the San Bernardino Sun on an article written by one of their columnists, Veronica D. Rugby. In any case, let's do a few updates. What related to uh, what you might do um, about your year-end tax planning. There are opportunities to save on taxes and tax traps that you'll want to avoid. You know, the with only 4.5 weeks before the 2024 tax season um, begins, filing season begins. This letter focuses on actions you can take to cut your federal tax bill. Now, on individual tax planning, look at the overall impact. Look at the overall impact on 2024 and 2025. The end game is to cut your tax bill over both years. And because the provisions affecting individuals in the 2017 tax year don't expire until after next year, 2025, you can't expect that the income tax rates and deductions for 2025 will be similar for 2024. And any big changes that Congress passes next year will likely first take effect in 2026. Most taxpayers will benefit tax wise if they want to do this type of planning, but generally the general rule is looking at 2025 and accelerating those write-offs. Accelerating the expenses um, into 2024, into this what will be your tax filing year, 2024. On the opposite side, if you have taxable income, that will likely be best projected on your tax return by deferring it to to 2025 tax filing year. Okay, itemizers who claim charitable deductions have a lot of flexibility in shifting their write-offs. Many tax experts um, recommend that you bunch the 2024 charitable gifts that you would normally give over multiple years, bunch those together in just 1 year. The don't donate assets, however, that have dropped in value. If you do, the loss is just wasted. So beware of this rule if you plan to donate lots of your income to charity. Charity contributions are deductible, as you may have heard. They're only deductible to the extent that the total write-offs do not exceed 60% of your adjusted gross income. By the way, that used to be 50%, but it has been upped or increased to 60%. That's the upper limit, 60% of your adjusted gross income. The AGI limit for donations, if it's a capital gain property, the upper limitation for what you can deduct is 30%. It's just half of the what's deductible on cash or income. Any excess contributions can be carried forward for 5 years. So for income deductions, the upper limitation is 60% of your adjusted gross income. For capital gain property, it's generally 30% of your adjusted gross income. Keep good records. If you are one of those who volunteer for charity, you can deduct 14 cents per mile for charitable driving. Other expenses incurred for charitable work are also deductible. If you itemize your on Schedule A, you should also consider incurring more medical costs before the end of the year. If your medical expenses have topped or are near 7.5% of your adjusted gross income threshold, just remember that the threshold, has to, exceed 7.5% of your adjusted gross income income threshold. In other words, it has to be the medical costs have to exceed 7.5% of your adjusted gross income. Check out publication 502. The list of eligible medical expenses is really very, very broad. It's a lot broader than you think. It includes glasses, hearing aids, health insurance, unreimbursed costs of long-term care, which is becoming more and more of a present deduction with the growth in our elder population and the many home improvements for elderly people to accommodate a disability or illness, because as we all know, when you get older, the number one choice is to remain in your own home before acquiescing to relatives' insistence that you move into a supportive living situation or a full-scale nursing facility. Okay, some filers can work the standard deduction by switching in and out between it, because you can itemize 1 year on the Schedule A, and then next year just switch back to taking the standard deduction. If your 2024 itemizations, which is now is about to come up, if they don't hit that, if what you itemize on the Schedule A doesn't hit the standard deduction amount, just delay incurring them and bunch them into 2025. If your itemizations are just over the standard deduction, accelerate some to this year, 2024, and itemize. Then take the standard deduction next year in 2025. The standard deduction for this year, for filing year 2024, is $29,200 for couples and $1,550 per spouse, 65 and up. It's for single people. That standard deduction will be $14,600. And for heads of household, the standard deduction is 21,900 for heads of household. I'm not going to mention the 2025 figures for now because it does tend to confuse folks. Okay, so some other items that you may want to just be aware of, and I will certainly repeat these updates as we get closer to the filing season, which really begins, in January of 2025, believe it or not, up through, of course, April 15th of 2025. So see if you qualify for the 0% rate on long-term gains and qualified dividends. Don't forget the qualified dividends also fit into that fit in as a long-term gain. If your taxable income other than your long-term gain or dividends don't exceed $47,000 on a single return, or $63,000 for head of households, or $94,050 on joint returns, then your qualified dividends and profits on sale of assets owned more than a year are taxed at 0% federal tax rate. So it's possible to take cash in on that break, on that 0% federal tax rate. But keep in mind that if you have had long-term gains and qualified dividends, there's still that you can't take that 0% rate if your income exceeds, as a single person, $47,000 and some change, or $63,000 for head of household, or $94,000 for joint tax returns. Also, keep in mind that your state income tax may jump up, since some states tax gains as ordinary income. You just can't get around that limitation. Oh, okay, folks. I hope you're staying on touch and in compliance with the RMD, required minimum distribution rules for traditional IRAs. Folks 73 years of age and older they have to take required annual payouts. So to arrive at what the 2024 RMD, required minimum distribution, is, start with your IRA balance as of December 31st, 2023, and use the tables in the IRS publication 590-B. If 2024 is your first RMD year, a required minimum distribution year, you have until April 1st of this next year to take that RMD, that is, makes sense that it's distributed to you, even though the amount is still based on your total IRA balance as of December 31st, 2023, if that's your first year. So now, if you opt to defer your first RMD to 2025, keep in mind you're going to be taxed in next year on two payouts. The deferred one, the one that you deferred for 2024, and the required minimum distribution for 2025. That certainly will increase, hike your 2025 income. There are similar rules that apply to 401k programs. However, Folks who work past age 73 can generally delay taking RMDs from their current employer's 401k plan until they retire. So they have that, usually that little break. For those who can afford it, charitable contributions made directly from a traditional IRA can save taxes. And the folks who are 70 and a half and up can transfer up to $105,000 in 2024 tax year from IRAs directly to charities. And that actually really does generate a extremely valuable deduction. If you're thinking about home upgrades for 2024 filing year, go green to claim one of two tax credits. You've got the residential clean energy property tax credit. That's equal to 30% of the cost of solar panels, solar powered water heaters, geothermal heat pumps, and more. Now, there's a second, smaller energy efficient home improvement credit for insulation, boilers, central air conditioners, water heaters, exterior doors, heat pumps, windows, and the like to meet certain energy efficient standards. The basic credit is 30% of the cost, and installations, don't forget the installation costs of these improvements. Also, in another area for gift tax exclusions for folks who can afford to give other people money contributions, you can give each person up to $18,000 without tapping into your lifetime estate and gift tax exemption. Larger gifts are smart tax move this year. You'll have to file a gift tax return on any gifts that are over $18,000, but you won't owe tax unless you use up the lifetime exemption. How about business taxes? Businesses can save on taxes with the first year bonus depreciation, which you can be using for your 2024 tax returns. Firms can deduct 60% of the cost of new and used qualifying business assets with lives of 20 years or more. So that's generally the rule. It has to, if you're going to use that bonus depreciation, it has to be it's limited to up to 60% of the cost of the new and qualifying business assets, and it has to have a useful life of 20 years or less, not over 20 years. And it has to be purchased and placed in service by the end of this year. If here you are in February or March of next year, and you're wondering, well, I just bought it in January 2025. Oops, that's not gonna work. Just be sure that you verify that the item was purchased and placed in service during calendar year 2024. Now, now you can, in addition to that bonus depreciation, you can use expensing in 2024 up to $1,220,000 of new and used business access expenses can be expensed, can be shown on your Schedule C or your business return. Keep in mind that the amount that you are deducting cannot exceed, and I say cannot exceed, the business taxable income. The software will not allow you to deduct anything above that, your taxable income as a deduction. Okay, something that's new, buyers of business vehicle, well, this really not new, but buyers of business vehicles can get the substantial tax breaks For new and used cars with bonus depreciation, first year deduction can go all the way up to $20,400. They have second or third year caps or limitations also. Now, regarding heavy SUVs, many people really saved a ton of money this way. And you can deduct up to $30,500 of the cost of the vehicle. 60% of the balance gets bonus depreciation, and the rest could qualify for regular 5-year depreciation. So you got start off with the 60% of the balance getting bonus depreciation, and then the rest of it can generally qualify for the 5-year depreciation. Keep in mind that big pickup trucks, you can expense up to 100% of the cost used in business, but that's subject to the rule that total expensing cannot exceed taxable income from the business. Also, see if you can use that 20% deduction for qualified business income, the QBI deduction. Folks who are self-employed and owners of LLCs, S corporations, and other pass-through entities can deduct 20% of the qualified business income. That's subject to the limits for joint filers with taxable incomes over $383,000, or taxable incomes for joint filers of $191,950. Okay, the Schedule E rental income, folks. If you do have that business, that rental income also may be eligible for deductions in some cases. Don't rely on that until you probably want to check with your tax advisor or CPA. Okay, with the president-elect, President Trump, he's, of course, very bullish on lower taxes. And, a lot of tax provisions, these tax provisions that were improved and really expanded back in the 2017, the odds for a big tax package couldn't be better. So it's likely that the Congress is really going to be digging in and doing a lot of work on the tax structure in this country. Mr. Trump will move fast on tax changes. Of course, that's become a top priority on his legislative agenda. Negotiating federal tax overhaul is even more crucial than in past years because of all the provisions affecting individuals in the 2017 Tax Cuts and Jobs Act. But keep in mind all of those increases and reductions in taxes, they're all slated and programmed to expire after 2025. And that includes lower individual income tax rates, considerably larger child tax credits, higher standard deductions, and then of course the $10,000 limitation on deducting state and local taxes, and the bigger estate and gift tax exemption. Some folks refer to these tax changes by such colorful names as Tax-O-Magon, the Super Bowl of tax, 2025 tax cliff, tax sunset, and more. I'm sure there'll be a lot more names as these things are mulled and decided upon by the legislature in 2025. So, as an example, just an actual example, if you look at your child tax credit, 2017 kicked that up to $2,000 per child. If no changes are made in that law during 2025, and no changes are made, then the rule is that the law reverts back to what was in effect in 2017. So it would revert. So if no change is made in that child tax credit legislatively, because will have expired in 2025 if no change is made, bang, the child tax credit will go back to $1,000 per child. Another example, big example, is your SALT taxes, state and local income taxes. Those there's a limitation placed on those in the 2017 Tax Cuts and Job Act. So if no change is made, the reverse is going to happen. If no change is made in that limitation, then folks with high property taxes, New York, Connecticut, New Jersey, California, they'll be allowed to deduct much more of their real estate taxes, and not be limited to that $10,000 total. That will be a horrendous gift to folks in high income states: New Jersey, Connecticut, New Hampshire, California, and that's going to be a big one, because another example is the miscellaneous itemized deductions for your work. The 2017 Tax Cuts and Job Act eliminated the deductibility of itemized deductions that exceeded 2% of your adjusted gross income, and that had been used, for years and years and years by small businesses, particularly. But if no change, is made, then many small business people, particularly, and medium-sized business folks, will be using the miscellaneous itemized deductions of old to increase their deductions on Schedule A. So that will be a huge gift to folks who are in smaller organizations and have these business itemized deductions that exceed 2% of your adjusted gross income. So the Trump does have lots of ideas when it comes to taxes. Some of his ideas, since he is now the current president, making the 2017 tax cuts permanent with even lower rates. Increasing, another one, if Trump is pushing, of course, is hiking or increasing the child tax credit, dropping the corporate tax rate. Oh, wow. Which is now, 21%? But even dropping that back down to 15% for a lot of C corporations. Imposing across-the-board tariffs on imported goods and ending green energy breaks. He would also let lapse the 2021 and 2022 expansions to the Obamacare subsidies. Those subsidies allow more people without affordable workplace health coverage to qualify for the premium tax credit. And that's all in return for buying health insurance to the marketplace. It's looking like the Republicans will end up winning the House. I mean, I think they did win the House. if the results hold and they keep the House, they'll have a fair amount of leeway to do what they want. Now, if Democrats somehow end up switching control of the lower chamber to their side, then the two parties will have to negotiate to come up with a compromise tax package. But I do believe that the House is pretty much in control of the Democrats in control of by the Republicans at the current time. If the Senate remains controlled by the Republicans, getting the Democrats to go along is not going to be an easy task. If they balk, GOP folks can try to use budget reconciliation to require a simple majority, not the 60 votes. That has been used many times by both parties. So that's going to be that's all going to be up to the political winds blowing through the House and Senate in this next year. Considering all of the other issues that have to be resolved, many people say, look to the Congress in winter of next year, in winter of 2025, for a big tax bill. With most tax changes taking place on a prospective basis, starting in 2026, the timing seems to make more sense, given the fact that the 2025 expiration of the 2000 tax law, that's what's in place. So it's that's something. At this point, I just do want to remind you that the reporter that you're listening to is Everett James. I do not work for IRS, and am simply reporting the tax news and issues without any other authorization or title. And we encourage you to call and take part in this program. My phone number for questions and comments, please call 951-522-9877. Again, 951-522-9877. And if you're more likely to use the email, evjtax1 at Gmail. That's evjtax1 at gmail.com. Okay, for those who take advantage of this offer for additional help, they will be rewarded with a free consultation during the 2024 tax filing year, which will be starting in, which will I will make effective in next January. This January coming up in about 4.5 weeks. Are some key dollar limits that one might be wise to recognize, and that's on the retirement plans, but they're all set to increase, as you might expect. Change. They are set to increase in 2025. The 401k limited contribution limit that rises to $23,500. People born before 1976 can contribute an extra $7,500. For folks who are 60, 61, 62, or 63 in 2025, this catch-up amount is even higher. Wow. So they increased the catch-up amount to $11,250. And that's thanks to the Secure 2.0 law. The cap on most simples rises to $16,500. The contribution limitation for traditional and Roth IRAs remains at $7,000. Then there's an additional $1,000 as an additional catch-up contribution for individuals who are 50 and older. Okay, folks, you've heard about the 1099K forms, and it's used by third-party settlement networks such as PayPal, Square, Venmo, StubHub, and eBay, and that's to send the forms 1099 to payees who are paid over $600 a year for goods and services. Well, the rules are slated, new rules are slated to kick in 2021, but those rules affecting the 1099K, the IRS delayed the changes. So the modifications are now scheduled to start for 2024 tax filing year for the 1099K forms. They are sent out early in the year, so they'll be sent out early this coming year. But there's going to be a significant twist. IRS raised the reporting thresholds to $5,000. For the 2024 1099K forms. So it's going to be the threshold used to be $600 or has been $600 a year. Folks who got paid for services or goods, requiring them to file either 1099 form or 1099K form. They raised that reporting threshold for folks who use the 1099K or receive 1099K forms. They raised that reporting threshold to $5,000 for 2024 1099Ks. Just keep in mind that under the old rules, 1099Ks were sent only to payees who with over 200 transactions in a year and who are paying more than $20,000. Now that's changed, and that's been replaced by the threshold of $5,000 for those who will be receiving 1099K forms. The 1099K form changes. They don't alter the taxation of the underlying transactions. So regardless of whether you receive 1099K for money received through a website or an app for selling goods or services, you're still taxed on the gain or the income. Okay, for folks in the audience who take big charitable write-offs, okay, well, make sure you can substantiate them. A couple reported $85,000 of non-cash charitable write-offs on a Schedule A. They claim that they made a one-time $50,000 donation of property to Goodwill and donated books worth $35,000 to another charity. Wow. The receipt from Goodwill actually didn't describe the donated items, and the letter from the second nonprofit was very vague. So I went to court, and the court said, well, these documents do not satisfy the substantiation requirements for deducting non-cash charitable contributions. So, claiming a large deduction on your tax return, can lead to an IRS audit, especially if the write-offs are disproportionately large compared with income reported on your tax return. That usually is a key factor in the agency's audit selection process. So, keep that in mind. There is a Senate bill that is being presented, which is hoping to improve customer service at IRS. Senator Bill Cassidy, Republican from Louisiana, and Mark Warner, a Democrat from Virginia, introduced that legislation, and it's supported by the American Institute of CPAs and National Taxpayers Union. Among the features are creating an online dashboard to inform people of backlogs and wait times for their tax returns and refunds. It requires the IRS to inform people with economic hardships who apply for installation agreements about collection alternatives. And they will expect to expand callback technology and online accounts. Those are really good. For folks who had a disaster, some people in federally declared disaster areas automatically have more time to file the 2023 tax year return, provided they submitted timely filing extension requests. So keep that in mind. All those of you who suffered through a horrible disaster. On the enforcement side, revenue that has been lost from tax cheating. Unfortunately, the tax cheating remains high. What are the most recent figures? Well, for 2022, tax cheating was substantiated at around $696 billion for 2022. That's the gross amount of estimated lost revenue not paid voluntarily or timely. The service estimates it will recoup $90 billion through audits, leaving what they call a $606 billion net tax gap. What are the biggest chunks of this tax gap? Well, employment taxes, erroneous credits, unreported and underreported business and non-business income of individuals. Despite that large figure, IRS is making a dent in the net tax gap because of heightened compliance and enforcement efforts. So those are some of the things. It would be interesting, at this point, because of the politics and the current winner of the 2024 election, heralding and raising expectations that there will be a return to the Trump economy. On this, I'd like to share with you an article from the San Bernardino Sun dated September 29th of 2024 by Veronica D. Rugby, R-U-G-Y, I'm sorry, Veronica D. Ruggie. I believe that's the columnist. I believe I'm corrected my pronunciation of her name. She says, while the gap may be closing, it's entitled, "We Cannot Expect a Return to the Trump Economy." This is just realities as opposed to hopes and wishes for the newly incoming president. While the gap may be closing, polls tend to show that more Americans, of course, trusted former President and continue to trust Donald Trump than Vice President Kamala Harris on economic issues. This sentiment is understandable given the strong pre-pandemic economy during Trump's first term and the challenges of inflation and declining real wages under the Biden-Harris administration. However, voters who are pinning their economic hopes on a Trump comeback, they might find themselves disappointed. There's no denying that the Trump era economy prior to COVID-19 was good. Low unemployment, strong GDP growth, gross domestic product growth, a booming stock market. Those were the hallmarks of his presidency. In contrast, the Biden Harris years have been marked by an erosion of American families' purchasing power. Adding to the voter skepticism about a Harris economy is the vice president's apparent lack of a clear pro growth vision. She's flip flopped on a lot of issues while rarely talking to the press. It's difficult to know what she really believes about critical economic matters like healthcare and fracking. When Harris has given specifics, they have not been spectacular. That includes her anti-price gouging idea, which she's repeated many times, and her desire to hike corporate and capital tax rates. She obviously believes growth comes from government. However, and this is Veronica De Ruggie, columnist. However, I have to wonder, that is, the columnist has to wonder whether a second Trump term would deliver the economic resurgence voters are hoping for. The circumstances Trump would inherit are far more challenging than the one he faced in 2017. Just consider, for the first one, government debt. On the eve of the pandemic, outstanding public debt was too high, around $18 trillion. But that $18 trillion pales in comparison to the current $28 trillion or so, an increase of $10 trillion. There's no reason really to trust Trump to cut spending or pass the necessary reforms. And that's particularly true because he explicitly says he won't touch Social Security. He won't touch Medicare. Those are the two main drivers of our fiscal problems. In addition, even with the economy booming during Trump's first term, he and Congress nevertheless managed to grow the budget deficit to nearly $1 trillion. It stands at nearly $2 trillion today, and is projected to reach $2.8 trillion in just 10 years. Wow. Now, Trump may believe he'll bring enough economic growth to wash away our financial troubles. But, I believe he's mistaken. The scale, I believe, that despite the fact that, I certainly supported his campaign, I don't believe, that's going to be possible. He's the scale of the current debt and future indebtedness is so large that economic growth alone will not be enough. There's a lot of evidence that debt will actually act as a drag on the economy, which would actually tend to reduce, any kind of economic recovery because of that debt we already have. Now, one of Trump's most pro-growth achievements was the 2017 tax cuts package. Perhaps only surpassed by his regulatory reforms. Some provisions are scheduled to expire after 2025, and those some of them I have mentioned. And Congress probably will make the extensions worse than the original law. Democrats are pushing hard to raise the child tax credits, as I mentioned, and other counterproductive tax breaks. Now, with deficits so high, there'll be a simultaneous pressure to raise taxes in a lot of anti-growth ways. With a willing Congress, Trump might manage to further lower taxes on corporate income and capital gains. But cutting taxes is unsustainable without cutting spending. And he's made the budget math even more daunting, more challenging by, you might say, recklessly promising to lift the cap on state and local tax deductions and lift the tax on tips and lift the tax on overtime pay and lift the tax on the Social Security income. And even, the tax on Social Security income brings in trillions of dollars. Well, Trump could achieve lots of growth with a rigorous energy deregulation program, but that's a serious political challenge. That requires a lot of discipline and a team that he may or may not have. Other Trump policy proposals could likely be destructive. He feels strongly that he'd have a better, he and other people feel strongly that he has a better instinct than in many cases people that would be on the Federal Reserve or the chairman in setting interest rates. But if he decides as president that he's the one who should control monetary policy, he'd be further polarizing what should be an partial, methodical job, meaning serious trouble in the long run. More bad news is that Trump just announced a intention or desire to limit interest rates on credit card debt. Price controls posed by Republicans are just as destructive as those proposed by the Democrats. An economy can survive a lot of abuses from the government, but it's almost impossible to endure politicians' attempts to overrule supply and demand. And supply and demand, and that can lead to serious shortages and other problems. We don't need to go through another supply chain interruptions. And also, this might be awesome or awful from this actually known Trump supporter. Is his proposal to impose across the board 10 to 20% tariffs, which is a special 60% levy on Chinese goods. Now, this would be enormously costly for consumers and, of course, damage the relationships with our best, probably, and most loyal traditional trading partner. That would deny American things that we want and need. The allure of returning to pre-pandemic economic prosperity, that's strong. That's a great attraction. But no administration can simply turn back the clock. Given some of the policies that Trump and company is talking about, he might have a harder time than people believe. That's by Veronica de Rugby from the San Bernardino Sun, dated September 29th of this year. So again, I'd like to, before I conclude, just re-mention my phone number and email for questions and comments. Please join Everett James at 951-522-9877, and my EVJ. My email is evjtax1@gmail.com. So for the folks who live in California, I did promise I'd give you the results of the election for California residents only. That's for the November 5th, 2024 election. There were 10, 10 propositions in all, 5 yes, then 5 resulted in no, no votes. The propositions required over 50% of the votes needed to pass. Some of those votes, some of those yeses were California Proposition 3, which repeals the same-sex marriage ban. So there was a 60, actually with that amendment that repealed that ban on same-sex marriage. The amendment itself is Proposition 3, and it repealed that same-sex marriage ban. So the same-sex marriage, banning that, that was the ban itself was repealed. So that was by 62% of the votes, 62.6% of the votes repealing that ban. Measure number 2, authorizing bonds for school facilities. That was approved by 58%, 58.6% of the voting authorized voting population. California Measure 34, which regulates spending by certain healthcare entities, that got squeaked by with 50.8% yes. What about some of the no's? Well, with Proposition 6, which prohibited slavery and involuntary servitude, that was turned down, allowing those things apparently to continue. But that was turned down by 53.3% of the voting population. Proposition 32, which raises the minimum wage, also that was turned down by 50.7% of the reporting population, voting no on that proposition. Proposition 33, which is repeals a ban on local rent controls, that was turned down by 60.1% of the population voting no. So the local rent controls appear to be held their ground. Proposition 35, extending the tax on managed care plans, that was a yes. And 67%, or nearly 68% of the voting population voted to extending that tax on managed care plans. And Proposition 36, which increases penalties for certain theft and drug crimes. Wow, that yes, and that definitely was approved. I think that was one of the higher percentages of the population. Yes, it was. Yeah, it had 68% of the voting public. So, folks, I think that will conclude our program for this week, and we look forward to your listenership next week.
Excellent, excellent, excellent. Thank you so much, Ev, for the valuable information that you share with us each and every week. As a matter of fact, while you were gallivanting around the world, I had one of our listeners said, "Well, where is the tax man?"
I love it.
So where's the tax man? So your information is being heard and shared. So thank you
Thank
so
you.
much for that. Yes, absolutely. Ladies and gentlemen, I want to invite you to stay tuned to the buzz. There's more music to come. I'm getting text messages in said, yep, after the show, keep the music going because I'm cooking. And I want each and every one of you to have a wonderful, wonderful holiday tomorrow. Just have a great time with your friends and family and loved ones. So tonight, you can tune in for a Thanksgiving special cultural excellence tonight with yours truly, me, WB, right here on the buzz. So in the meantime, enjoy your Wednesday and look forward to hearing and seeing and communicating with you again real soon. So